So what we have learned so far is that what is the money market, securities, how means they can be issued. Then we talk about the monetary supply, money supply. What are the main features of money supply? Let me turn on the light so there you can see better. You're good to go. Sorry about my comb. I just rushed in somewhere and came back. Now, we talked about money market securities, which are mostly, remember one feature, remember always, it's short term. Short term means it's maturity. Maturity means whenever you want cash, you can take that promissory note to the issuing authority and they can give you the cash. Its maturity is less than 1 year. It can be a week, like for example, we saw like some instruments, their maturity level is up to a week, right? And money market security, we talked about that a lot. Money supply, how does it work? Now we see that how does money supply impact, affect the countries the country's economy. And when we talk about country's economy, we came to this phenomena of welfare. Welfare means income. So because we are dealing with the financial aspect, so it's better to call it income. Or in simple way, you can call in economics way, you can call it GDP. GDP, what is GDP? GDP is a gross domestic product. So if I ask you, what's the total value of your house? So you will include everything, right? You will include the house, you will include the value of a bed, you will include the value of your computer, means everything, right? So every finished product. Finished goods and services. Now, what is the difference between finished and why we use finished word finished? Because like, if you consider cotton is like a crop, and it can be, we can take the value of the cotton, and then from that cotton we extract the thread or string. Then we consider the value of a string as well, and then we make clothes, right, from that string or thread, and then we conclude we also include the value of that clothes. So it will give us like wrong information, because if there is a cloth, so value of cotton is inside, value of a thread is inside that piece of a cloth, right? So that's why we always consider finished good, because shirt is a finished product, right? So if we consider step by step, it's like a lot of like misinformation, and that value won't be a correct one, and we can end up with a wrong analysis, and people are gonna say that, oh, you don't know how does it work, right? So remember always the value of a finished goods in the country, and the product and the services, they are considered as gross product, or the income you generate within the country. It doesn't matter if a foreigners. So there's a difference between GNP and GDP. GNP means gross national product, and gross national product means, for example, I'm a foreigner and I'm earning money in China, and I'm just like taking that money and sending it to back my home, or whenever I travel back, so I take, or I'm investing it back at home. So it should be excluded from Chinese income, because that's going out. Similarly, some Chinese worker, they are working abroad, they are working in states, they are working in Gulf area. So in that case, So in that case, their income shouldn't be included in that country, but should be included in the Chinese economy. So that's known as, when we do that, that's known as gross national product. But if we talk about gross domestic product, then it doesn't matter. Whatever I'm doing in China, then you just consider my services in China as a part of gross domestic product. So mostly we take gross domestic product uh, to express the welfare or income of any country. So we have to see that how the money supply, because there are two views. One view says that money supplies this GDP, this income, a lot through interest rate, right? Through inflation. Um, so its impact here is a lot. Another group says, no, it's not a lot. It's not a lot. So who are those people? Of course, they are not like a layman. They are not like a fruit sellers or a barber or other people, other profession. They are professional economists, right? Both of them. So their value, their expert opinion have their expert opinions have some value, right? So that's have some credit worthiness. So we should trust them, right? But it depends who you are. Like, look, there are different school of thoughts, right? It is not important that you go for all of them. You can choose one. Okay, I like this way, so I'm gonna understand in this way. So one are monetarists. Monetarists. The other are Keynesians. Now, what's the main difference? Monetarist says that everything depends on supply and demand. If there is a high demand, there will be a high supply. I mean, the price will be settled by through invisible hand. Whereas J.M. Keynes, yeah, J.M. Keynes was a really famous economist in 1930s when that Great Depression of 1930s happened. So Keynes used to say one thing. He said that he used to say that everyone knows everyone knows that in long run the storm will go away, but the problem is that we need to find the solution during the storm. So if the typhoon comes, how are we going to handle the situation? Because everyone knows after some time the typhoon will be gone, and the people who will survive, they will survive, and the people who will be dead, they will be dead. So the Keynes used to say that everybody knows that, because they says that just leave it with the invisible hands of supply and demand. So because of the Great Recession in 1930, so Keynes come up with its own school of thought that's known as Keynesian school of thought. And the main theme of the Keynesian school of thought is that the central bank, the government, has a role to play. So if there is some problem going on, the central bank, the government should interfere and provide some packages to the victimized sector. I explained you during the uh, crisis period. So we need to solve the issue by giving a bailout package to that sector. Otherwise, the things can go worse. Someone wants to ask a question or what? I saw a raised hand. Anyway, so let's see what's their stance on this, on money, on this relationship of money supply, not money market. Now, today you will know the link between finance and economics in a better way. Now, the definition of GDP. That is the value of all finished goods and services produced within the boundary of the country. I repeat, within the boundary of the country. So, whereas money supply is all the money which is being circulated within the boundary of the economy. So we are not dealing with that money which we have invested abroad, right? So only within the country. So if the boundary, so everything is happening within the boundary. So these are the slides, and where is my screenwriter? Okay, here it is. Now, some important concepts. Understand that how does it function. Monetarists, they claim that the money in an economy can be determined by the level of GDP. So we can also say that the level of GDP is an economic activity. It means the higher the income is, income can be generated. How can you earn more income? Of course, when you're gonna do work, when you're gonna move a little bit, when you can have an activity, right? So it also shows the higher activity. So when there is a high activity between, means people are investing, things are being produced, industry is working fine, then GDP will increase. The export will be higher, so GDP, the overall income will be increased. So that's the monetarist claim. The monetarist claim that money supply can have an impact on GDP. How? Let's see. But before that, you need to know the velocity of money. So you know the concept of GDP. You know the concept of GDP. You know the concept of money supply. Let's write money supply as MS. And then there is another concept, that's velocity of money. And you can say money velocity or velocity of money. So money supply, you already know. GDP, you already know. What is the velocity? Velocity in physics, maybe if you have learned physics in your high school, right, you should know that velocity means the rate of change. That's it. We're just gonna consider this rate of change. Rate of change in speed is the velocity. Rate of change in the speed is velocity. That's, we know that. So here, when we talk about money velocity, so we are talking about the rate of change in money. What does that mean? Means how the money gonna change. I mean, means how how can we measure the rate of change in money? It's really simple. That means how much money, how many hands the money changed. It means circulation. Understand? How many hands money changed. So here we are talking about the circulations. So money velocity means circulation of money within an economy. So monetarist claims that if we divide GDP by total money supply, it gives us the velocity of money. So from here, we can consider this applies. This is really important to understand. Or maybe I can write on the whiteboard. Yeah, I should write on the whiteboard rather than here, because then it will be more clear. Okay, so we can move a little bit like here. So what the monetarist says, that money supply, GDP, velocity of money is equal to GDP upon money supply. That's understandable. That total income divided by total supply of money, that's the change in money. All right, that's how, like we saw a graph, like the change was in 8,000 first, and then before it was like 6,000 something, like whatever. So the income divided by the total supply of money is velocity of money. So it means GDP can be equal to money supply times velocity of money. Now if we know these both, we can find out the equations. We can also recall that what is total income. Can I say that, let's say I have a factory, what is my total revenue? I'm asking to the accounting people. I'm producing 100 mobile phones a day. Each mobile phones I have a price of 20, right? Whereas my cost is 10. My cost is 10. So accounting guys, tell me how much total revenue I will get and how much profit I will get. Quickly. So simple. You are studying accounting, right? You should know that what is total revenue. I'm not asking to the business guys. Let me see. So yeah, somebody answered me. Okay, so I suppose that 2,000 is my total revenue and 1,000 is my profit, right? That's exactly right. I couldn't read your name, otherwise I could have read your name. So I'm really sorry for not reading the Chinese name. If it's in pinyin, it would be easy. Yeah, that's right. That's really right. A student just told me that it's 2,000. So here, what is the total income? This is the income. Total revenue means total income of a factory, right? Total income of a company. So if we are talking about the GDP, we already defined GDP, that GDP is like a total products and services, value of a total product and services. So what will be the total income? Can we write GDP as like a total output, a total production times price? Can I write this? Yes, I can write this. So from here, I can say it's equal to money supply and money velocity times money velocity. So from this equation, I can rewrite this into total production as total output or real output, as in book, and PL as a price of labor. Now, from this equation 1, what can we interpret? We can analyze the basic relation, that is increase in money supply. What will happen if we have increase in money supply? If we have increase here or increase in money velocity or increase in both money supply and money velocity. Do you understand? So all these cases, for example, if this side increases, what does that mean? It can cause increase in production. This one, it can increase in production because they are directly related, right? If increase in one, it will also get increase. So this is the phenomena of a real life. So it will increase in production or increase in price or increase in both. So that's the problem. If it increases price, not production, if increase in, let me say, now you understand. So let's say this is right hand side, which is this one, and this is left hand side. I'm just nominating so that so it means increase in left hand side can increase in right hand side. So if this increase in right hand side is because of the prices, then it means it's gonna cause inflation, which is not good. If it increase on right hand side is because of increase in output, then it's good for economy. So you see how money supply impacts. Someone asked me a question or what? GDP. Yeah, that's right. So it means that if we have that's how money supply can impact the GDP, through real output or through inflation. It can have a inverse relation, it can have a direct relation. So monetarists believe that money supply is a really important tool to define the GDP of an economy. Do you understand this concept? And mainly, if there is an increase in money supply in left-hand side, and there is no increase in output but increase in price, that mainly causes inflation. That's why most of the economists, especially Keynesian economists, they discourage central bank or the government to issue more currency paper to fund their deficits. Because in poor countries, they play really smart. So I'm telling you the mechanism of these small governments, smart governments who are trying to be smart, but at the end they will face really big issues, economic issues. So what do? For example, right now I need money and my credit worthiness is not good because my economy is not good. I'm a country. So what will I do? So what? I have a machine to print out the notes. So I need money so I can print the notes and I can fulfill my expenditure. In short term, in very short term, it's maybe I can bail out myself. But what will happen? It will increase the prices. And when the prices increase, inflation increase. When inflation increase, it impacts other, for example, like it will impact the wages as well. For example, right now you are getting like 2,000 RMB per month, and you can buy this. If the prices increase in that 2,000 RMB, now you will buy half. So there will be a chaos in economy. So that's why economists mostly they suggest not to issue more currency notes through because of the increase in money supply. So we know that if there is an increase in M naught, especially M naught in money supply, because if in money supply things can be increased because of the increase in M naught, increase in M1, or an increase in overall M2. But we consider M naught. So M naught is the main culprit behind the price level, impact on price level. So we need to, whenever you are studying any situation, financial situation, you need to consider this M naught very well and the inflation concept. So this is the one aspect which is monetarist, how monetarist thinks about the impact of money supply and GDP. Understand? You can note it down. I give you some second to digest this. Okay. So now we're gonna move to the Keynesian sides. So you understood the concept of the monetarist. I will ask you at the end, which one do you like? Which one will you prefer? What do you think? Which one is better? Then I will tell you which one I prefer. Okay. Now, Keynesian is very simple. Keynesian says no, there is not a direct impact, and there is not a lot of, there is an impact, but there is not a lot of impact. So Keynesian believes that there is not such immense direct impact of money supply on GDP. Their claim, the Keynesian says, Keynesian means school of thought, not one person. Keynesian's school of thought thinks that there is a GDP impact of money supply on GDP, but not through money velocity, not through real output, but through interest rate. Now that sounds more financial, right? Because we are now we brought interest rate in it. How? Look, very simple. It says that this is money supply. So we all know if there is a high demand, there is a low price. There's an inverse relation between demand and price. So what is interest rate? Interest rate is basically a price you take on the value of money. Yeah? The profit margin on the value of money. So if there is an increase in money supply, this will probably lead a decrease in interest rate. Right? Why? Because because I know that increase in money supply can cut down money demand. So if there is no money demand, it means people not gonna invest. So why people are not investing? Because there is a low interest rate in the banks, which is the price of the money. So that's why increase in money supply applies that there is a decrease in interest rate. Now, if there is a decrease in interest rate, it applies that increase in consumption. So people are not giving in the banks, in the depository institution, or in the money market securities, because of the profit margin is really less. So what they're gonna do? They're gonna consume. They're gonna invest in the market, right? They're gonna spend in some, means you're gonna go for shopping, right? Rather than to give it to the bank. When this thing happens, it can imply that there is a high economic or financial, more than economic, financial activities. Means a lot of trading within the country, right? A lot of buying and selling of products, a lot of movement, circulation of money. So it increases the circulation of money, which further impact the GDP to increase. Right? Similar thing happens in an opposite way. If the money supply decrease, banks need more money. Banks needs more cash. Yeah. So what will do? Bank will increase the interest rate, so people should give them. That's really obvious because we already know that bank needs liquidity. Bank needs cash. You remember when we talk about the money placed against the gold placed against the money, so the reserve. So if there's less money supply, the interest rate will high, so that because bank needs liquidity. So this high interest rate let the people not to consume, not to invest, not to spend. In monetary way, it's opposite, right? Here, it's opposite. So they say that if there's decline in money supply, the interest rate goes up and the GDP decline at the end. The overall income will be declining. So that's the basic concept of money supply in Keynesian and monetarist. Now, I have a question for you. What do you think? Which one is better, or which one will you choose? Which one will you choose? What do you think? Which one has better system? Which one is more efficient? Hmm? Which one is more efficient? Why are you so slow? Only one person. And can you write your name in Pinyin so that I can pronounce your name? Yeah, means I personally am, because I'm a pro-Keynesian, because my school of thoughts are pro-Keynesian, because I believe, okay, Huang, yeah, you're really right, Huang. And I will also encourage the rest of the students, come on, there are 55 students. So you should also participate, right? It's only the Huang seems to be active. Um, so I personally believe Keynesians because I think the government should interfere. Otherwise, if we just let the things depend on the supply and demand, like the monetarist, things can go wrong, and they could go wrong, and it's really hard to control. Because at the end, we have seen twice in depression, depression and the recent recession, and there was also oil crisis. We will talk about the oil crisis of 2015. In 2015 there was an oil crisis. We will see there was also financial reason behind the oil crisis, especially trading, and especially trading with the dollar. um, we will talk about this now in last half hour. That's why I told you that this is really important to understand. And that's why in every case the government should interfere, and they did it actually. So if the government did interfere and solve the issue, then I think this is better. But anyway, there's a school of thought, another school of thought which believes that classical is right, Keynesians are not right, and they also have a strong arguments. But it depends again. Both things are right. For example, you want to go to Beijing, there are two ways. You can go for with the train, you can go by air. So some people they prefer train, right? It doesn't mean that train is not good enough. Some people think that train is better than the plane traveling, and some people think that the plane traveling is better than the train traveling. So these are just two school of thoughts, remember. So I'm not telling you to follow me. Whatever you think that this is, because every person has a mindset. So you can, whatever you analyze based on your analysis, you think that okay, if the Keynesians are right, so then you welcome to the school of thought of Keynesians. Otherwise, welcome to the school of thoughts of classicals. Both are right and both are wrong somehow. So there are loopholes in every system. So let's talk about international monetary system. Now, this system I was talking about. Now we will see. So far we talked about the system within the country. Now we're gonna talk about international monetary system. So now you will know that what are the games and what are the financial gimmicks at international level. And believe me, that's not different than what we do among ourselves. It's the same thing, right? Almost same thing. So my laptop's battery is dying, so I'm gonna charge it before it again disturb our class. Now, as you know, that the international monetary system was linked with gold initially, like in 1800, like before 1800. We talked about the history of the paper money and currency money, right? So during the 19th century and 20th and early 20th century, I'm giving you the one financial version of, or one financial explanation of this issue, right? So in 19th century, late 19th century and early 20th century, or before that, everything was traded on gold. So a country who has more gold can do the international trade easily. And the country who has less reserve, they cannot do the international trade that freely. And because of these things, something happened in Europe. There was a depression, and that depression led the World War II in 1935 to 1939 in Europe. So main reason behind that is just to acquire more resources, because whenever you are in financial crisis, you need money to bail out some stuff. This is really an important phenomena. And you can only, either you can have a lot of money in reserve, and if you don't, you you just acquire, which is wrong, but you acquire. For example, let's say you are hungry, right? You're feeling hungry. Now you know that the student next to your seat is having some lunch box. You have two options. Either you can go outside, buy lunch for yourself and eat, and fulfill your hunger, but you don't have money. Then to fulfill your hunger, what you can do, you can either ask your friend, like ask the next student to share his or her meal with you. But if he or she says, no, I don't want to share, you have another third option. You can steal his or her food. But that's really morally not justified. So exactly the same thing happened. Exactly the same thing happened during the World War, during the Great Depression of 1930s. You see that we always see the impact. So these are really highly, all the social issues are highly related and highly linked with economics and finance. Remember this. That's why economics is known as a mother of social sciences. If we see the Great Depression of 1930s, it caused many countries in a vulnerable situation. So they didn't have enough money to bail out their sectors or whatever economies. So what did they do? They said, okay, acquire the next country. It's really simple. We can take their resources to feed our economy. That's it. That's what happened. So when this happened, the other country, they joined another country and they made a group. So there was like two major group formed, and that happened. And you see, even in current scenario, US is always like trying to start some kind of conflicts in the regions, different regions. Why? To gain the resources. The main reason of US to come in Afghanistan was about to take resources to in Iraq, in Middle East, because of the oil, right? Otherwise, why will a country spend so much money to get into another country? Because it costs. This is one way of uh, dealing the situation. The other way is brilliant way, and as I told you, it's like the central government should act wisely. The other way is Chinese way, to broaden the exports, to broaden their production level, that so that every country becomes your dependent and you can generate money through an economic activity. Now this one is really efficient way, and that can save a lot of energy for a nation. So that's one reason. Okay, that's a little bit about the background of the international monetary system, how it started. So first it was linked to the gold until early 20th century. But after that, when the World War happened, there was an agreement signed. That agreement is known as Bretton Woods. This Bretton Woods was a guy. So this was a Bretton Woods Agreement. And since then, there is a new phenomena in money. So what the Bretton Woods Agreement said, it happened in 1944. What happened? They changed the phenomena of gold. They said instead of gold, we couldn't like take gold as a common currency. What we can do, we can, because before gold was linked with international trade. In 1944, different nations after World War II, many nations lost a lot of things. So the winners who won the game, who won the war, they made this agreement with the losers. That's how it happens. That's how the survival for the fittest happens. So they made the agreement and they said, because US was the major player, right, including the West, but at the end the final blow was by the US. So US made there was a Bretton Woods Agreement in, I think, in UK in 1944, and in that agreement they said that we from now on we're gonna use US dollars instead of gold with any international transaction. Look at the impact of the US economy boosted suddenly. So every country raced behind the collection of dollars instead of gold. So every country, they try to increase their reserves in US dollars than in gold. Two things. One thing, US at any point can depreciate, can lower down its dollar value. So every country who is having a lot of dollars, they will certainly lose the money. So to make other countries dependent on you, this agreement still is a hurdle. It's like it really works. It's a fantastic plan. It's a fantastic financial plan, right? To make other people, other countries dependent on your country. Awesome. In 1997, there was a financial currency crisis. It happened because there was Asian tigers, Indonesia, Malaysia, Indonesia, Thailand. I mean, there were 5 Asian countries who were like booming in economy wise. What did US did? US just depreciated the dollar currency and they lost the money. If I have a dollar, if US, because US is printing the dollars, so if US decline the dollars, it will have impact on me. So that's the main phenomena behind the financial expertise. So you can find out different ways to secure yourself. At the central part of this agreement, that everyone agreed on this. So everyone has to pledge. Before they used to pledge gold for making international trade. Now they need to pledge US dollar, and for that they need to collect US dollar. They can collect US dollar from by increasing export or in any other way against the goal, and evaluated its currency. So now, before the currencies were evaluated, that how much gold a country has, then it defines the value of the currency. But now, and mostly because gold has a common value everywhere in the world, so it was no issue. But now every currency like RMB should be evaluated in dollars, and that's known as exchange rate. So you said, I want a trade, but the trade must be happening in US dollars, so you demanded you need US dollars, so you give me RMB, so I will calculate that, okay, this much RMB you give me, I will give you this much dollar. That's exchange concept of exchange rate came into existence. The exchange rate was fixed until 1973. So the US didn't change the exchange rate. So it defined every country's, it evaluated every country's, how can you say, the rating, and then it decided it's every year, every month or every 6 months, it decided that this is the US dollar rate for this currency. In 1973, they allowed to float. What is float? Let me erase it and tell you in a better way. So before, until 1973, it was fixed. Fixed means certain amount that the US gonna decide, and or the country itself gonna decide that I'm gonna buy the US dollar for this much RMB. Otherwise, I don't need to buy dollar, but everybody needs to buy dollar. So anyway, so after 1973, they allowed to that the currency countries can also do the float. Floating means it who will. So in this case, the central government decides the price of local currency into dollar. In floating, demand and supply in economy in a country decides the price of local currency in US dollar. Then later on, some countries, they use fixed floating. Fixed floating means they have a cap. Cap means boundary. For example, the government says that, okay, from this amount to this amount, you can decide on the money supply and demand. But if the money supply and the dollar supply and demand ask for more than this, then you cannot do that, because then we fix this range. So in fixed floating, they fix. So there are three kinds of exchange rate. I hope that you have understood this, fixed, float, and fixed floating. So you see how US incorporated US dollar in every economy. That's one reason. Let's discuss a little bit about this. That's the one reason that I think in like 5 years, 10 years ago, now China has a lot of reserves, and mostly the reserve is in dollar, because every country is supposed to keep the reserves in dollars. So in China US trade, US always threatened China for this thing. They said, no, if you're gonna make international trade, because now at this moment China is having international trade with many countries in RMB. So China is trying hard to make RMB not universal, but at least regional currency. What is regional currency? I will tell you. Regional currency means it's like trading with different countries. It's accepting their currency. They are excluding dollar between them and the partner country. For example, if China is trading with means in African country, so they accept like in RMB, and African country accept the RMB. So African currency can buy the RMB and give it to China, and China can sell the product. So that's happening. So they allowed. Similarly, some Asian countries. That's why US is really against China. That's one reason, because that's how there is a competition. There will be a competition of RMB and US dollar in that case. It's gonna take time, not now, but maybe 20 years, 30 years, maybe more than that. The Chinese RMB can have enough strength to compensate, to alternate the US dollar. So that's the one reason. Now let's talk about, we can define exchange rate as a value of currency in terms of another. What is a regional currency, or you can say common currency? So you understood exchange rate, right? Let's go further about common currency or one currency. Best example, euro. Now, instead, European countries, they are small, they're together. The same phenomena as I just told you now. Different countries, they need to trade to each other, from each other, and they need to buy gold. I mean, not gold, US dollar, to buy from each other. So they decided, okay, let's get together and let's make one currency so that we don't need to buy US dollar whenever we want to trade. We can trade in one currency, and we can have one currency everywhere in every European country. So many European countries who are in the European Union, they let go their own currencies, right? So there was but some European countries who are part of European Union, but they didn't let it go. For example, England was a part of before, now it's Brexit. So before it was a part, but they still had like a sterling pound. Similarly, Sweden had still like a Swedish krona, and some Scandinavian countries, mostly they have their currency, but Germany, France, they let go their currencies. Poland, Italy, Spain, all these countries, they let go their currencies. So the euro is standard. Okay, we're gonna finish at in 8 minutes. Okay, so don't just go out from the room. I can see it. Anyway, so euro is a single currency replaced by the individual currency of a group of European countries. You all know about the Brexit. Then there is another concept that is a digital currency. Digital currency means electronic money that can be used as making payments. Centralized digital currency is backed by the central bank, just like Alipay, you know, WeChat coins, Alipay coins. So this is all digital coins, right? And it is backed by the central bank. Remember, the money supply, which controls the money supply. Central bank controls the money supply, and it is digital currency is backed by central bank. So it is authoritative. Then we talk about a little bit about Bitcoin. Bitcoins is also digital, but it's not backed by the central government. So it is backed by individual. Any individual can set the price. So that's why, because it's not regulated, that's why many countries are opposing this. I think like China has also opposed it because it's not centralized. So you can deceive anybody at any point. So that's not a good way. But many countries, they adopted Bitcoins. It's a new concept. Most of the countries didn't accept it. As I told you, it's decentralized in nature. It was introduced in 2009, and if we will have time, we can discuss about this thing. I will ask my friend to give you a whole 1 hour or 1.5 hour class on Bitcoin so that you know about these concepts. Now, what would be the next currency? Can you imagine? Because you can imagine now based on your thinking. Let's briefly discuss the role of financial institutions. So that's most of it. That's all for today's class. But one more concept I need to tell you before I leave. Let me share the screen. So you know the concept, you know the monetarist point of view, you know the Keynesian point of view. Then you know all the concepts of exchange rate, historical perspective, common currency, digital currency, and bitcoins. There is some homework. Page 42 and 43 is like briefly discuss the development that led to the 2007 and 2008 financial crisis. It's really easy now. You know that, right? It's like a story. And there are 3 questions. Question 1, 4, 7 on page 33. Now, let's talk a little bit about banks and other financial institutions before we leave in 2 minutes or 3 minutes. You know mortgage, right? So when the pools of mortgage got bigger in order, what's the role of the financial institution in the crisis, during the crisis? Because at that time banks used to give loans for home, and the policy was to initiate the home ownership, right? So pools of mortgage got bigger in order to achieve higher numbers of loans based securities against houses. Other than banks, other firms, private firms, they also took part in that. With different financial institutions, they repackage the loans into security so that the value of these mortgage, I'm sure you can see me, right? Can you see me? It's okay, you can hear me, right? If you can't see me, the value of these mortgage based, the value of these mortgage based on the value of the homes. In simple way, we can all mortgage backed security because it was backed by the home. So the value of this, so when the house prices declined dramatically, the people lost jobs, so they were unable to pay back. Hence there is an increase in mortgage defaulters, also known as moral hazard situation. So price of mortgage securities also declined, and in that instance, when a lot of financial institutions were at the merge of collapse, literally like there was a lot of merger happened during that course of time. So many big and credible institutions, when they were on the march, many other institutions, they bought them, they merged their businesses with them, by, of course, by the support of the central government or the Federal Reserve Bank. So then we will talk more on the financial institution in next lesson. So until now, that's it. I wish you a happy, because especially for international business students, so just have our view of this lesson later on. I will try to upload the videos as well. I'm recording all the videos at the moment, but I didn't have time to upload it. So I will upload it soon. So maybe during these holidays.